Most people are misreading XRP right now. SWIFT has just taken one of the biggest steps towards blockchain-based finance, but the headlines have created more confusion than clarity. Understanding what actually changed matters because it reshapes how institutions may move money and tokenized assets over the coming decade. In the next few minutes, we'll separate fact from fiction, examine SWIFT's new blockchain infrastructure, Chainlink's role in interoperability, and where XRP generally fits inside the institutional payment ecosystem. Not based on speculation, but on real infrastructure and real adoption. SWIFT's latest blockchain launch has triggered two completely opposite narratives. One claims this proves SWIFT is secretly adopting XRP. The other claims Ripple has been left behind. Neither tells the complete story. What actually happened is far more important than either. SWIFT has introduced a blockchain orchestration layer designed to connect traditional banking infrastructure with multiple distributed ledger networks. Instead of replacing existing payment systems, it's creating a framework that allows institutions to access tokenized assets and cross-border blockchain settlement without rebuilding decades of legacy infrastructure. That decision and design changes the conversation entirely. Because this isn't about one blockchain replacing another. It's about building an interoperable financial system where multiple networks compete on liquidity, compliance, and efficiency, and real-world utility. And once you understand that shift, XRP's role becomes much clearer. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. See, for years, blockchain enthusiasts imagined a future where traditional banking systems would simply disappear. Reality has been very different. Large financial institutions operate under strict regulatory requirements, extensive compliance obligations, operational risk controls, and decades of interconnected software. Replacing that infrastructure would introduce enormous operational risk. Instead, institutions prefer gradual modernization. This is precisely why SWIFT's new blockchain framework matters. Rather than replacing settlement systems, it coordinates communication across multiple blockchain environments while preserving existing governance structures. Think of it as adding a modern navigation system to an existing transportation network instead of rebuilding every road. Payments become more efficient. Liquidity becomes easier to manage. Settlement windows can expand, but institutions continue operating with familiar regulatory frameworks. This incremental approach is exactly how financial infrastructure has evolved throughout history. One technology layer builds upon another. Rarely does an entirely new system erase the old overnight. Short-term noise, long-term structure. That is the pattern institutional investors continue watching. History offers an important perspective. During the introduction of the SWIFT messaging network in the 1970s, banks faced another transformational moment. Before SWIFT, international payment instructions were often transmitted through telex systems that were slower, less standardized, and more prone to operational errors. Banks didn't immediately replace every internal process. Instead, they adopted a standardized communication network that gradually improved efficiency across global finance. That historically transition reshaped international banking without requiring every institution to rebuild itself from scratch. Today's blockchain evolution follows a surprisingly similar pattern. The messaging layer evolves first, operational confidence develops, adoption expands gradually, only then do deeper structural changes begin. But here's where it gets interesting, ladies and gentlemen. Instead of connecting banks only to each other, today's interoperability layer can connect banks to multiple blockchain ecosystems simultaneously. That dramatically expands what financial institutions can potentially accomplish over the next decade. One of the most significant aspects of SWIFT's new infrastructure is the technology enabling interoperability. Chainlink's cross-chain interoperable protocol, commonly known as CCIP, serves as the abstraction layer connecting different blockchain environments. That sounds technical, but the practical implication is straightforward. Banks no longer need separate integrations for every blockchain network. Instead, they communicate through a standardized interface interface capable of interacting with multiple distributed ledgers. Imagine an international airport. Passengers speak different languages. Airlines use different reservation systems. Aircraft come from different manufacturers. Yet the airport coordinates them all through standardized procedures. Chainlink performs a similar function for blockchain communication. It doesn't determine which blockchain wins. It enables communication between many of them. That philosophy reflects something institutions value enormously: optionality. Financial institutions rarely want exclusive dependence on a single technology provider. They prefer diversified infrastructure capable of adapting as markets evolve. SWIFT's architecture appears designed around precisely that principle. The phrase chain agnostic may sound like industry jargon, but it carries enormous strategic importance. It means SWIFT isn't committing the future of global finance to one blockchain. Instead, any compliant distributed ledger with significant security, scalability, and liquidity could potentially participate. That creates competition. Competition encourages innovation. Innovation improves infrastructure. This is very different from many narratives circulating online. The future institutional market is unlikely to crown one universal blockchain. Instead, different networks may specialize. Some could focus on tokenized securities, others on cross-border liquidity, others on central bank digital currencies, others on real-world assets like this SICID. Interoperability then connects those specialized ecosystems together. Prices reacting, systems evolving, and understanding that distinction helps investors separate short-term market narratives from long-term infrastructure developments. One of the strongest pieces of evidence supporting institutional blockchain adoption arrived through the U.S. tokenized money market fund collateral sandbox. This wasn't merely a theoretical exercise. It involved more than 300 participants and over 120 organizations testing real financial transactions involving tokenized collateral. Major names participated: asset managers, technology providers, financial institutions, infrastructure companies. Transactions occurred across Hedera, Ethereum, Hyperledger, Bizoo. That last network deserves particular attention because Hyperledger Bizoo also underpins SWIFT's blockchain ledger initiative. The objective wasn't choosing a winner. It was demonstrating that tokenized assets can move securely across compliant financial infrastructure. That's a profound shift, ladies and gentlemen. See, institutions are no longer asking whether tokenization is technically possible. No, they're testing how to implement it safely at scale. Now, this is what most people miss. The value of those pilots isn't measured by media headlines. It's measured by operational experience. Every successful institutional transaction reduces uncertainty. Every completed pilot builds confidence. Every compliance review strengthens future adoption. Financial revolutions rarely begin with explosive announcements. They advance through thousands of successful operational improvements. This brings us to perhaps the most misunderstood part of the entire discussion. XRP was not the settlement asset used inside the particular tokenized collateral sandbox. That is an important fact, ladies and gentlemen. But it does not mean XRP has no institutional role. Instead, XRP participates through a different pathway. Ripple's on-demand liquidity service enables cross-border liquidity using XRP as a bridge asset, and integrations through networks such as Thune create optional connectivity between SWIFT participants and Ripple's liquidity infrastructure. That's so big, ladies and gentlemen. Those are separate developments. Conflating them creates confusion, ladies and gentlemen. They do. SWIFT's blockchain architecture is intentionally open. Banks may choose different liquidity providers depending on geography, regulation, costs, counterparties, and corridor-specific needs. That means XRP competes on utility, not exclusivity. And perhaps that's the strongest signal of all. Institutional finance isn't building a future around one blockchain. It's building a future where multiple technologies compete on efficiency, liquidity, compliance, and real-world performance. As tokenized assets continue expanding and financial markets move towards continuous settlement, the winner may ultimately be the networks that solve genuine institutional problems, not those generating the loudest headlines. If SWIFT's blockchain launch represents the infrastructure, ladies and gentlemen, then tokenization represents the opportunity that infrastructure is being built to support. Over the past few years, tokenized assets have moved from niche experiments to one of the fastest growing areas of institutional finance. As of May 2026, Tokenized assets under management reached approximately 8.4 billion, representing growth of nearly 298% in just 1 year. That isn't simply impressive growth. It reflects a structural change in how financial institutions increasingly think about ownership, settlement, and liquidity. Traditionally, transferring financial assets involves multiple intermediaries, reconciliation processes, settlement delays, and operating hour limitations. Every additional intermediary introduces costs, operational complexity, and potential friction. Tokenization seeks to simplify much of that process. Instead of relying on disconnected databases, ownerships can be represented digitally on distributed ledgers, allowing transactions to become more transparent, programmable, and potentially far more efficient. But here's where it gets interesting. Institutions aren't tokenizing assets because blockchain is fashionable. They're doing it because reducing settlement times can improve capital efficiency, lower counterparty risk, and unlock liquidity that was previously trapped inside slow financial processes. Those are measurable economic advantages, and that's exactly what attracts institutional capital. Another development reinforces this broader transformation. The Depository Trust and Clearing Corporation, better known as the DTCC, has begun extending U.S. securities clearing hours, moving the financial system closer to near continuous operations. See, at first glance, that may seem unrelated to blockchain. In reality, the connection is significant. Global markets no longer operate only during local business hours. Investors trade around the clock. Digital assets never close. Foreign exchange markets span multiple continents. Capital increasingly moves 24 hours a day. Traditional settlement infrastructure, however, was designed for an earlier era. Limited operating hours create delays, liquidity bottlenecks, and unnecessary friction. SWIFT's blockchain initiative aligns remarkably well with this broader modernization. An orchestration layer capable of supporting continuous payment availability complements longer clearing windows and increasingly tokenized financial assets. In other words, separate institutions are solving different pieces of the same puzzle. Prices reacting, systems evolving, and the direction of travel appears increasingly clear. Financial history reminds us that the infrastructure revolutions often unfold quietly before becoming obvious. Consider the container shipping revolution of the 1950s and 1960s. Before standardized shipping containers, loading cargo was slow, labor-intensive, and expensive. Every port handled freight differently, creating delays across global trade. Then standardized containers transformed international commerce. Ships became more efficient, ports modernized, supply chains accelerated, global trade expanded dramatically. The innovation wasn't glamorous, it was infrastructure, yet it changed the global economy. Today's blockchain interoperability may represent a similar transition. The public often focuses on token price. Institutions focus on infrastructure. If payments, securities, collateral, and tokenized assets can move across interoperable networks with lower friction, the long-term economic impact could prove far larger than today's daily market volatility. That's why institutional investors increasingly watch infrastructure announcements more closely than social media narratives. So where does all this leave XRP, you might be asking, ladies and gentlemen? Some investors expected SWIFT's announcement to declare XRP as the universal settlement asset for global finance. That didn't happen. Others interpreted the absence of XRP from the sandbox as evidence that Ripple had been left behind. That conclusion also goes too far. The reality sits between those extremes. Ripple's on-demand liquidity platform continues solving a very specific institutional challenge: cross-border liquidity. Instead of requiring banks to pre-fund accounts across the world, XRP can function as a bridge asset for certain payment corridors where liquidity, regulation, and economics make sense. That capability remains distinct from SWIFT's interoperability layer. The two aren't mutually exclusive. They address different components of international payments. Banks could use SWIFT's orchestration framework while selectively accessing Ripple's liquidity service through integrations like Thune, whenever doing so provides measurable benefits. Now, this is what most people miss, always. Institutions rarely choose one technology forever. They choose whichever solution delivers the best results for each specific use case. That means XRP's future depends less on marketing narratives and more on whether it continues demonstrating lower costs, faster settlement, reliable liquidity, and regulatory acceptance across real payment corridors. Ultimately, Utility determines adoption. One of the biggest misconceptions, though, in crypto has always been that the belief that only one blockchain can succeed. Institutional finance doesn't operate that way. Different financial institutions have different priorities. Different jurisdictions have different regulations. Different assets have different settlement requirements. Different payment corridors have different liquidity profiles. Expecting one blockchain to dominate every application ignores how financial systems actually evolve. See, instead, the emerging picture is one of speculation. Some networks may excel at tokenized securities. Others may dominate stablecoin issuance. Others may become preferred for central bank digital currencies. Others could specialize in commodity settlement, trade finance, or cross-border liquidity. Interoperability then connects those specialized ecosystems. Think of it like modern transportation, commercial airlines, rail networks, shipping lanes, highways. Each serves a unique purpose. No single transportation system replaced all the others. Together, they created a stronger global economy. Blockchain infrastructure may evolve similarly. Multiple specialized networks connected through the standard interoperability. That appears increasingly consistent with what institutions are actually building. That brings us to an important distinction investors should remember. Speculation moves price. Infrastructure changes economy. Markets often become distracted by short-term narratives. Was XRP mentioned? Which blockchain processed one pilot? Which company issued the press release? Those questions matter, but they aren't the biggest questions. The more important questions are these. Are institutions investing? Are regulators becoming more comfortable? Are settlement systems modernizing? Are tokenized assets growing? Are payment infrastructures becoming increasingly interoperable? Across nearly every one of these categories, the answer appears to be yes. That doesn't eliminate uncertainty. Adoption will likely remain gradual. Competition will remain intense. Technology will continue evolving. But the structural direction appears increasingly difficult to ignore. Short-term noise, long-term structure. That distinction has defined nearly every major technology transformation throughout and transition through financial history. Perhaps the best analogy is the construction of the Roman road network. The roads themselves weren't the financial objective. They were the infrastructure that allowed commerce, communication, military logistics, and economic expansion to flourish across an enormous geographic area. The value wasn't in the roads alone. The value came from everything the roads must and made possible. Today's interoperable financial infrastructure could serve a similar role. SWIFT is building communication. Chainlink enables interoperability. Tokenization creates programmable assets. Ripple provides an alternative liquidity mechanism for specific corridors. Other blockchain networks contribute their own strengths. Each becomes part of a broader financial ecosystem rather than existing in isolation. That's a far more realistic vision than expecting one protocol to replace the entire global financial system. Institutions generally diversify risk. Infrastructure evolves incrementally. And successful technologies earn adoption through measurable performance, not slogans. So what should investors take away from SWIFT's blockchain launch? First, the launch validates that blockchain technology is becoming an increasingly important part of institutional financial infrastructure. Second, SWIFT's architecture is intentionally chain agnostic, allowing multiple distributed ledgers technologies to participate rather than selecting a single winner. Third, the institutional tokenization trend continues accelerating as asset managers, banks, and financial market infrastructures invest heavily in programmable financial assets. And finally, XRP's position should be viewed realistically. It was not the settlement asset in the latest tokenized collateral sandbox, but it remains a legitimate participant through Ripple's on-demand liquidity ecosystem and related integrations that connect institutional payment flows. That distinction matters because understanding reality is far more valuable than believing either exaggerated optimism or unnecessary pessimism. The financial system isn't changing overnight. It's changing one payment corridor at a time, one institutional integration at a time, one successful pilot at a time. Those incremental improvements may never generate the excitement of viral headlines, but over time, they can reshape how trillions of dollars move around the world. The next decade may not belong to one blockchain. It may belong to the networks that consistently deliver liquidity, interoperability, compliance, and measurable value for institutional operating at a global scale. That's where investors should keep their attention, because while prices will continue reacting to daily news, the underlying financial system is evolving in real time, and that evolution may ultimately become the biggest story of all. If you've enjoyed this deep dive, make sure to subscribe, leave a like, and let me know your thoughts in the comments. Do you think the future belongs to a single dominant blockchain, or are we witnessing the emergence of a true multi-chain financial ecosystem. As always, thank you for watching. I'll see you in the next episode. Happy Friday, everyone. Hope everyone's having a blessed day. So much to talk about, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. I want to discuss further escalation to the U.S.-Iran war, because this is what we've been harping on in these parts of the video for quite some time. You see oil prices rising right now. You see West Texas intermediary crude futures. They rose almost to $82.49. You see a lot of things happening. Brent crude futures almost went to around $88. But look at the infrastructure that's getting hit. Kuwait said on Friday, Iran attacked the power and water desalination plant. And there has been 6 consecutive evenings of strikes against Iran, hitting dozens of military targets, logistic infrastructure, maritime capabilities. So you got a lot of things going on as this expands, ladies and gentlemen. And there is something that you have to come to terms with in this market. And this is something that's very, very important. Look, this is part 2 of the Harry Dooney Freak Show. It's part 2 right now. And you're looking at prices at the time of this recording, things don't look so bueno. Trades look bueno, but overall thoughts, not so bueno. I spoke about this morning on Fox Business News, a lot of going over about the Clarity Act, why it has to get done, why it doesn't have to get done. We're in the camp that it gets done. But you don't want to get cut up like sushi right here, ladies and gentlemen. This is where you got to have that Gucci conviction, that Gucci clarity. This is where you don't look every day what's going to happen, what's not going to happen. When there's discounted values, this is not financial advice, just my own opinion, entertains any capacity. When something's on a discount, if you're thinking about doing something, it's better to buy it when it's on falling as opposed to buying. Because when it starts to rally and rise, I call it rise, you get less. Ladies and gentlemen, one good tip from the pits can pay for your entire year subscription. If you're looking for the deeper macro research, come and join over 600 active traders and investors inside the Crypto Public Desk Monthly who are taking advantage of all this financial chaos again. Because the key in this business that I was taught on the floor of the New York Mercantile Exchange, use the chaos between events to build your stacks of high society to accumulate the positions that you want. That's the most important thing. Because most people think the world runs on oil. It doesn't. The world runs on things that oil quietly produces. And sulfur might be one of the most important of them all, ladies and gentlemen. That's why almost nobody's talking about it right now. Everyone watches the price of crude oil. Everyone debates OPEC interest rates, inflation, geopolitics, blah, 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 blah. But underneath the surface, there's one and another market that sends a very different message. Sulfur prices may have exploded because the physical material is becoming harder to find at source. And that tells you something much bigger happening beneath the headlines. This isn't some niche chemical story, ladies and gentlemen. This is a story about the foundation of modern civilization. Think about it for a second. Sulfur becomes sulfuric acid. Sulfuric acid is one of the most important industrial chemicals ever created. Without it, you don't have modern fertilizer. Without it, you got no copper mining, becomes dramatically more expensive. Without it, semiconductor manufacturing faces serious challenges because the ultra pure sulfuric acid used to clean silicon wafers is absolutely essential. So when sulfur becomes scarce, you're not looking at one commodity, ladies and gentlemen. You're looking at a pressure spreading through agriculture, mining, manufacturing, technology all at the same time. We get calls every day from our plants in Indonesia from people looking to source sulfuric acid because that's a byproduct of refining. You can't get it anywhere. For long-term members of the Crypto Public Desk Monthly, we're taking advantage of nickel for a long time. This is the kind of signal most people completely miss because it's boring. It's like watching paint dry on the wall. That's why they go into things and get cut up like sushi. But here's where it gets interesting. The shortage isn't happening because the world suddenly forgot how to produce sulfur. It's happening because sulfur is largely a byproduct of refining sour crude oil. When refineries slow down or shut down, sulfur production falls with them. That means geopolitical disruptions don't just affect gasoline and diesel. They quietly choke off the supply of one of the world's most important industrial inputs. This is what macro investing is really about. It's about understanding second order and third order effects. Everyone sees oil. Very few people ask what happens when the byproducts disappear. If Persian Gulf refineries reduce output because storage is full, shipping routes are disrupted or exports slow down, sulfur production falls. then sulfuric acid becomes more expensive. Fertilizer produces and feels the pressure. Copper miners feel the pressure. Chip manufacturers feel the pressure. Now, suddenly you're talking about food inflation. You're talking about constraints, copper supply during one of the biggest electrification cycles in history. You're talking about AI infrastructure needing more semiconductors, while one of the chemicals required to manufacture those chips becomes more and more expensive. You see how everything connects, ladies and gentlemen? This is why I constantly tell people to stop looking at markets as isolated events. Nothing exists in isolation anymore. Energy affects chemicals. Chemicals affect mining. Mining affects metals. Metals affect AI. AI affects productivity. Productivity affects inflation. Inflation affects central banks. And central banks affect every asset class you own. It's one giant interconnected system, ladies and gentlemen. One battlefield. The people who constantly stay ahead aren't necessarily smarter. They're simply looking one layer deeper than everyone else. Here's another point that deserves attention. Unlike many financial markets, today sulfur isn't heavily driven by speculative paper trading. This is largely a physical market. That means when prices rise dramatically, it's often because real buyers are competing for real material. That's a very different signal. When physical markets begin tightening, you pay attention because physical shortages can't be solved with headlines. They require time, investment, logistics, and production. And those things don't happen overnight. Now you think about copper, Dr. Copper, baby. Everyone knows Dr. Copper, constant copper, is the critical electrification data centers, electric vehicles, transmission infrastructure, AI power systems. What few people appreciate is how much sulfur acid may copper operations consume during extraction. People don't pay attention to this at all. I write this down. I'm nuts about this. See, if sulfur acidic prices continue rising, lower grade copper projects suddenly become less profitable. Someday, some may delay production. Others may become uneconomical altogether. Now ask yourself this question. How do you build the energy transitions without enough copper? How do you build AI infrastructure without enough semiconductors? How do you expand global agriculture without affordable fertilizer? This isn't fear. It's systems rethinking. It's recognizing bottlenecks before they become front-end news. History has often shown over and over again that shortages rarely announce themselves politely. They build quietly. Then suddenly everyone notices at the same time. By then, prices have already moved, unfortunately. Investment opportunities have already changed. Supply chains have already adjusted. That's why I believe one of the biggest mistakes investors make is waiting for mainstream confirmation. By the time the headlines tell you everyone, something matters, markets have already been pricing it in for months. We go over this. If your long-term view is this, you hear things that are happening way before most people hear. Because being a financial mercy, we only care about being right and winning, not tweeting or talking about anything on bank accounts. That's all that matters, not benefactors. See, sometimes years, most people only become interested after the move. That's backwards. See, positioning happens before the narrative. You got to be in it when you're watching paint dry on the wall, when it's boring, when you got that Gucci conviction, that Gucci clarity, when your mind will play tricks on you. That's why you got to be the general of your mind. It's a battlefield. See, this is true in commodities. It's true in macro. It's true in the crypto. And it's true across every major structural shift we've ever covered on this channel. This sulfur story isn't really about sulfur. It's about learning how to recognize hidden stress inside the global system. Because once you train yourself to see these connections, you stop reacting emotionally to headlines. Instead, you begin asking better questions. What are the bottlenecks? What industries depend on this input? Who benefits? Who struggles? What happens next? Those are the questions that separate long-term investors from short-term speculators. Most people will eventually understand why sulfur matters. They'll understand after fertilizer costs rise, after mining costs increase, after supply chains tighten, after another inflation scare appears, after the markets are already adjusted. But positioning doesn't happen after everyone agrees. Positioning happens while everyone else is still debating whether the story even exists. What matters? That's exactly what we're doing inside the Crypto Public Desk Monthly. We're not chasing headlines. We're tracking the underlying systems that move markets because and before they become obvious. Inside the desk, the tips from the pits updates focus on exactly these developments of the kinds, the quiet signals, the most investors overlook because they're boring. We break down where capital is flowing, which macro indicators deserve attention, and which narratives are gaining real traction versus those driven by short-term noise. The goal isn't to predict every headline, ladies and gentlemen. It's to understand the system well enough that when the headlines arrive, you're not surprised. You're already prepared. If this started to click for you and you're beginning to see why, understanding these deeper connections matter, then you probably find those deeper discussions valuable. Because one good tip in the pits can cover your entire membership, ladies and gentlemen. The link's below. I'll see you inside. Ladies and gentlemen, none of this is financial advice, just my own opinion. This video is for education on entertainment purposes only. It's not financial advice. Never, ever invest because of watching a YouTube video ever. Consult a licensed financial advisor. The market's going to keep doing this. Escalation, de-escalation, the war escalates, inflation goes down, blah, 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 blah. This means people are getting caught up like sushi because people got to make their numbers. Learning to pay attention to what's quiet when I go over all of this is how you get ahead in this space. It's all one battlefield. Every investment class is just one player on that battlefield, one regiment. I'm going to tell you this right now. Paying attention to what's boring is how you get wealthy, ladies and gentlemen. Not financial advice, just something you can do day in, day out. That's why half the time, if you make it to this part of the video, I salute you because you're so far ahead about what happens. My Lord, I love you all, ladies and gentlemen. I'm going to see you on the front lines. And ask yourself this question. Are you investing because you want to invest? Are you investing because you need to invest? Are you investing because you don't want to miss the change? I'd like to know in the comments below, because if you make it to the end of the video, to me, your comments matter more than people who just sit there and say, blah, 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 blah. You're here to learn. You found the Republic. You found our wolf pack. Because, ladies and gentlemen, if you want to learn to trade, if you want to learn to invest, come and join the Crypto Public Test Monthly. One tip pays for everything, ladies and gentlemen. I love you all. I'll see you on the front lines. None of this is financial advice, just my own opinion. But right now, King Dollar Daddy-O is in town. Have a blessed evening.